This is Optimal Finance Daily, episode 862. What is an index fund and why you should care? Part 1 by Nick True of mappedoutmoney.com. And I am Dan. I'm your host here on the show. This is where I read to you from some of the very best personal finance blogs on the planet. And before we get to that post from Nick, I want to thank Fundrise for their support. They're frequently mentioned as a recommended tool in blogs that I narrate here, and for good reason. Fundrise enables you to instantly access high-quality, high-potential private market real estate projects, from high-rises in D.C. to multifamily apartments in L.A., and each real estate project is carefully vetted and actively managed by Fundrise's team of real estate pros. Fundrise is the future of real estate investing. Visit fundrise.com/OFD. That's fundrise.com/OFD to have your first 3 months of fees waived. Now, today's post is a little on the long side, so I'm going to read the first half today and I'll finish up the rest tomorrow. So with that, let's get right to part 1 as we start optimizing your life. What is an index fund and why you should care? Part 1 by Nick True of mappedoutmoney.com. Great. Index funds. Another complicated investment term I don't understand. At least that's how I felt when I first started learning about investing. It's hard to keep everything straight in your head. Index funds, mutual funds, stocks, bonds, Roth IRAs, 401ks. Why are all these names so weird? Well, luckily, we've had a lot of great people go before you and me and figure all this stuff out for us. So today I'm going to share what I've learned about index funds from other people and why I think it's the absolute best way for us to invest. This is what I use, and it's probably what you should too. Let's jump in. Stock market index. Before you can understand what an index fund is, you have to understand what a stock market index is. Basically, an index is simply a collection or group of stocks that have been put together. You may have heard of the S&P 500 index or the Dow Jones Industrial Average. Both of these are examples of stock market indexes. The S&P 500 is a group of the largest 500 companies in the U.S., and the Dow Jones is a group of 30 large companies in the U.S. Another major stock index is the Wilshire 5000, which is an index that attempts to include almost all the publicly traded stocks in the U.S. Other major stock indexes include the Russell 2000, the NASDAQ Composite, and the NYSE Composite. All of these indexes track a certain portion of the stock market based on company size or industry. All you really need to understand is that a stock index is just a group of stocks together that tracks the performance of that group as a whole. If you ever hear someone say, the stock market's down 10%, they're likely referring to one of the indexes, and more often than not, they're talking about the S&P. How index funds work. An index fund is a special type of mutual fund. Rather than leave the stock choices up to an individual fund manager or firm, index funds simply track a specific index. They do it by buying a portfolio of stocks that aligns as closely as possible to that index. For instance, both FUSEX and VFINX are index mutual funds that track the S&P 500. This means that they attempt to hold the exact same balance of each stock as the index weights it. These index funds are capitalization weighted or market weighted. What does that mean, you ask? Good question. Here's an example. Although there are 500 stocks in the S&P 500, each stock doesn't account for 1/500th of the money in an S&P 500 index fund. Rather, each stock makes up the same percentage as its size relative to the other companies. Let's look at Apple. Apple is the largest company in the country right now, and as of February 8, 2016, it makes up 3.19% of the entire S&P 500. That is considerably larger than if you took all 500 companies and evenly distributed them at 1/500th, which would be 0.2%. So if Apple makes up 3.19% of the S&P 500 and you invest $1,000 into VFINX, which is an S&P 500 index fund, that means 3.19% or $31.90 will be invested in Apple stock. Similarly, Amazon makes up 1.33% of the S&P 500, so $13.30 of your $1,000 would be invested in Amazon stock. And then the rest of your $1,000 would be invested in the other 498 stocks according to their size as well. Index funds are about as boring as they sound. They just track along with the index. No fancy stock picking, no top 10 hottest stocks now, just plain old investing in the whole market. If the S&P 500 gains 7%, your money gains 7%. If it goes down 5%, your money loses 5%. But don't worry, when it comes to investing, you want to be super boring. That's how you win. Let's find out why. Here are the major advantages of index funds. There are many advantages to index funds, and they all center around three fundamental ideas. 1. No one, or at least less than 2% of people, can predictively and consistently beat the market after fees. 2. The only thing you have control over when you're investing is the fees you pay to invest. And 3. Keep it simple. Index funds shine when compared to active management and stock picking. They require minimal effort, normally less than an hour per month, if that in many cases. They rely on the stock market as a whole rather than someone trying to beat the market. And because they don't have to pay managers to actively oversee and choose the investments, they're able to maintain extremely low fees. Here's how they outperform. Ultimately, stock picking is a loser's game, even for the professionals. An article in the New York Times discusses a study conducted by S&P Dow Jones. This study looked at 2,862 broadly diversified, actively managed domestic mutual funds operating between March of 2009 and March of 2010. It chose the top 25% of these funds and tracked their performance over the course of the next few years through March 2014. The study looked to see which of those funds that started in the top 25% stayed in the top 25% for each of the four 12-month periods between March 2010 and March 2014. The answer? 2. That's right, 2 out of 2,862 funds invested in the same type of stocks were able to consistently outperform. That's 0.07%. So here's the problem. If it's that rare for mutual fund managers to consistently outperform, what makes you think you can choose the right mutual fund that will? That's right, you probably can't. But that's okay, I can't either. That's why I invest in index funds. That way I'm guaranteed the market return. If you're investing over the long term, which you should be, indexes will beat the large majority of actively managed funds every time. To be continued. You just listened to part 1 of the post titled, What is an Index Fund and Why You Should Care? By Nick True of mappedoutmoney.com. And thank you again to Fundrise for their support. Fundrise is a highly recommended tool among authors we narrate here, so check it out. Come by fundrise.com/OFD to have your first 3 months free. Private market real estate has historically provided excellent ongoing cash flow even as it supports long-term growth. Private market assets like these are a strategy for diversifying beyond public market investments and even other kinds of real estate like publicly traded REITs. And Fundrise is the future of real estate investing. The platform's innovations power an investor-first model by eliminating the bloated costs and middlemen that have traditionally weighed down real estate investing, saving investors time and money. Unparalleled transparency and real-time reporting let you see how the development of specific properties impact your overall portfolio. So come try it out. Visit fundrise.com/OFD. That's fundrise.com/OFD to have your first 3 months of fees waived. And that's going to do it for today. Thank you so much for listening. Have a great rest of your day, and I'll see you back here tomorrow for the Wednesday show, where we'll finish up this post and where your optimal life awaits.